Hi, everyone. Good morning. Thank you and welcome to Tenet Group's first quarter 2022 financial results conference call. My name is Raji Wahidi. I'm your VP of Operations for Tenet Group, and I will be your host for today's call. I'm joined this morning by Johnson Joseph, President and CEO of Tenet Group, Jean Landreville, CFO of Tenet Group, Liang Q, known as Golden, CEO of Tenet China, and Mark Schwallenberg from MZ Group. Before we begin, kindly note that some statements or comments made on this conference call may be forward-looking statements, which may include but are not necessarily limited to financial projections or other statements of the company's plans, objectives, expectations, or intentions. At this point, I'll turn the call over to Johnson Joseph, who will discuss our first quarter results, with further input on our financials from Jean Landreville, followed by a Q&A session, which will be moderated by Mark Schwallenberg. Over to you, Johnson.
Thank you, Raji. Good morning, everyone. And as Raji said, welcome to our Q1 2022 financial results. So I'm just going to give a brief summary of what took place in the first quarter of this year. Then I will pass it on to, as Raji mentioned, to Jean Landreville, our CFO, who's going to talk about some specific points related to the results. And then I will come back and discuss the circumstances that led to the revision of our guidance for 2022. Okay, so very briefly, our business is continuing to expand very well in China. The first quarter is typically the slowest quarter for us in terms of revenue generated because obviously there is the Chinese New Year break that lasts for anywhere between 3 weeks to a month. So all in all, we're very pleased. We generated $34.7 million during the quarter. Once again, the supply chain business was very strong for us. So there is a continuously strong appetite from retailers, distributors, and everyone that uses our services to manage their cash flows and become more efficient. So as far as demand is concerned, there are no issues there. So for how much we can grow our business in China. So again, first quarter was very good on the consumer goods supply chain aspect, which remains kind of like the bread and butter of our business. Now, what we were trying to focus on in the first quarter is to get into other verticals that have more interesting profit margins for us. For example, we had a little bit more activity in the oil and gas sector, which is good. We want to put more emphasis on insurance and eventually getting more involved in the clean energy space. Now, on the clean energy front, what took place during the quarter was not necessarily revenue generating activities, but it was more strategic for us. So we worked on a couple of pilot projects with China Engineering Energy Corporation, who we are establishing a very good relationship with. So we anticipate eventually having an agreement in place with CEEP that will allow us to become a relevant player in China on the clean energy front, but not only in China, but potentially in other parts of the world as well. So in addition, other than our desire to enter different markets, we also want to round off our offering on the business hub. So right now we provide financing, purchase order, but we also want to control every aspect of what goes on the business hub. So for instance, when it comes to the transfer of funds, settlement, financial settlements, that's why we have we're able to use the China Union Pay Network to open virtual bank accounts. But now we also have an agreement with CIB that will allow us to also provide fund transfer and payment processing services. So controlling every aspect of the transaction. So something gets done, company gets financed, they get the funds required for their business. We'd like to be involved in the transfer of funds, settlement of accounts when they want to pay their bills. We want to be involved in that as well. Now, most of the transactions that occur on the Business Hub generate shipping opportunities. So in the first quarter, we launched a platform called UnFleet, which will allow us to provide shipping services. Before, we're outsourcing those services, shipping and warehousing, but now we want to take control as much as possible of every aspect of the transactions that go on within our Business Hub. So anything that needs shipping, we'd like to be able to send that over to our UnFleet platform. So we're getting shippers involved to joining the Business Hub. Transactions that may require insurance as well. So we have the Heartbeat platform, the Heartbeat insurance brokerage platform, where we're going to be customizing specific insurance products to go along with the transactions that we facilitate through the platform. So essentially, that's what we want to do. We want to continue to round off our offering. Business is growing in China. And obviously, it takes more capital. I'm going to get into that a little bit later. But overall, that's what took place in the quarter. It's a very, very strong demand, continued strong demand for our services in China. Looking at entering new verticals, being more proactive, particularly in the insurance and oil and gas sector, with an eye on the clean tech sector. The clean tech sector, the clean energy sector, we anticipate that we're going to be more active in the second part of 2022 with revenues to be generated probably in Q3 in that sector, and then ramping up from there. So essentially, that's a round off of what took place in Q1. Now I'm going to send it over to Jean Landreville, our CFO, who's going to talk about some specific numbers, and then I'm going to come back and discuss the reason for our revised guidance. Jean?
Thank you, Johnson. Good morning and welcome everybody to this presentation. So we put a small slide, a resume there to compare the results between Q1 of 2022 and Q1 of 2021. In summary, revenue that was mentioned, 34.7 million in Q1 22 compared to 14.2 million last year. So that's an increase of $20 million in one quarter. So impressive revenue increase and some good takeaway there. So the increase of 20 million is coming mainly from our Gold River platform, which is the ASST subsidiary. So it's a plus 25 million compared to last year. AGP, the petroleum subsidiary, is making the supply chain revenue, and on the platform is plus 7 million. That was not there last year. So there's a good improvement and fair margin in that. And we take away some revenue from ASSC, which was low margin last year, around 2%. So we reduced that to almost zero in the 2022 quarter. So that's good for the margin, and it's a company that we own at 51%. So we switch revenue to our platform that we own at 100%, which is good news. The other thing, just to finish on revenue, is we start in the first quarter. Remember, we made the acquisition of Heartbeat last year. There was almost no revenue at the end of the year. There was some delay, so it's kicking in Q1 for $500,000, not much, but it's increasing. So it's one of the questions I saw, and it's begin in the first quarter of 2022, which is good. Cost of service to deliver the supply chain, 30 million versus 12 million. Well, it's in line with the revenue. The good thing there is that the margin, the difference between the margin that we have in Q1 of 2022, sorry, and Q1 of 2021 is higher by 6.7%. So we're close to the 10%. We're 8.8% in the quarter versus 2% of last year. So that's a good news there also. Salaries and remuneration and friend benefits. Well, we're increasing the number of headcount. So the difference quarter to year over year is 92% more. Mainly, half and half, 45 headcount additional in Canada and the same about in China with all the acquisition and the increase of business that we've done year over year in China and Canada. Canada is the tubular and Tenet business that we're following our plan and increasing our workforce there. We also introduced at the beginning of the year to make sure to attract people especially in Canada. We introduced some group insurance and good cotization to RRSP for our employee. We need to attract people, and as you know, it's a very tough market, very competitive. So we have to be competitive to attract people. So that's increased the salary for 1.7 million. Consulting fees. We're aiming to get to senior exchange market in Europe, and we need some consultation there. So we put some investment in the first quarter in that consulting fees to get to the market and to know better and to make a good introduction to our European capital market. Professional fees increase. Well, the business is increasing, so audit fees, legal fees increasing. This is normal. And additional to that, we want to make sure that we have a very good internal control base to get close to a SOX compliance by the end of the year. So we hire in China and Canada, we hire professional from the Big Four company in audit to help us to develop our internal control process. And this is also in line for our future growth in anywhere in the world. So we can take this system that we're building in North America and China, and we're going to be able to replicate this and have good internal control all over the world. All we're going to be, and I think it's important. It's an investment, but at the end, the cost is you get paid back on this very quickly with good internal control. The finance costs increased by 400,000. Where I want to point out there is that it's not cash out; it's only an accretion over the acquisition of Heartbeat. So we're gonna make payment in the future based on revenue and profit that we're gonna have in Heartbeat. So we make an actualization of these future payment. So when we're getting closer and closer to the payment date, there's an accretion between the difference of the actual rate that we're using versus the rate of the market, and you call that accretion. So it's an accounting expense, but it's not cash out. And this is the only difference this year for the 400,000, and you're going to see that in the next quarter. It's going to be recurring for the next 2 years, depending on the amount of contingency we're going to pay. For now, Heartbeat is going well, so I think we're going to pay what we forecast last year. So this is going to be there for the next quarter at the same level around. Amortization of intangible asset, 1.4 million more again. So this is not cash item. Amortization of the Cubular platform that we acquired last year and the Heartbeat platform that we acquired, and we continue to invest in our platform in China. So when they start using the platform, we're starting to make amortization on it, and that's why we have this increase of 1.4 million. This is not cash out again. All the other expense that we have. So at the end, net profit 3.3 million loss for the quarter, counter if you compare it to 400,000 last year. Now a lot of non-cash item like the finance cost in for the contingency and the amortization depreciation of the intangible asset. So this was my quick review of Q1. Coming back, giving back the slide to Mr. Joseph. Thank you.
Okay, thank you, Jean. Okay, now briefly, I want to talk about the revised guidance. I think the best way for me to do that is I'll start by telling you what the original plan was. Okay. So for those of you who are familiar with the company, you know that we closed a prospectus financing last summer, and we were listed on the NASDAQ, I think, in September, if I'm not mistaken. Okay. So when we listed on the NASDAQ, obviously there's a reason why we wanted to list on the NASDAQ, visibility, liquidity in the stock, but it was also to access the US capital markets, right? So the plan was to list on the NASDAQ, file a base shelf prospectus in the US, and raise 30 million US dollars shortly thereafter after the listing. And then we use that capital to continue to execute our business plan. Now, that was part of the original plan. And we had commitments that we had in China. So the numbers that we had forecasted, and I'm talking about the 300 million this year in revenue, 300 plus million in revenue this year, the EBITDA, everything was based on that plan. So a huge part of that plan was having 30 million US dollars, which is roughly between 35 and 40 million Canadian dollars in our bank account at some point late summer, early fall, and then we proceed with the plan, right? We proceed with our plan. Unfortunately, what ended up happening was we received a notice from the SEC telling us that they had new guidance for companies that had operations in China who were controlled by Chinese interests. We're not a company that's controlled by Chinese interests, but still we fell under the new guidelines. So the notice that we received was basically just a review of our registration or our registration statement or our Form F or 40F form. So when we looked at the notice and we looked at the questions that were being asked, we figured that, okay, you know what, this is a process that's going to take a week, maybe a couple of weeks, and then we'll get the situation cleared up. We'll get back on the NASDAQ, and then we'll proceed with the capital raise that we had intended to do. Unfortunately, that's not what happened. So we got the questions from the SEC. We came back with some answers. There was more questions and so on and so forth. So make a long story short, what we believed was going to be a matter of a week or a couple of weeks ended up taking we're 6 months, 7 months later into the process. And there has been no resolution. Now, looking from the outside, you may say, hey, you know what, like, this, you should have realized that this was not going to happen and you needed to have adjusted your plans accordingly quicker. Our response to that is the exchanges, the dialogues that we have had with the SEC led us to believe that this was something that was going to have a resolution in fairly short order. So every time we had an exchange with the SEC, they had questions, we came back or whatever, we always felt that, okay, you know what, we're almost there. Okay. So we did not think it was necessary for us to make any adjustments, so to speak, to the forecast back then, right? But at the same time, the commitments that we needed to make for example, to ShopEX, right? So I know that a lot of our shareholders have questions about ShopEX. How come you didn't get more of their clients onto the Business Hub? There's also an agreement that we had announced with I think it was Mellow Coffee or something like that, where this was a great opportunity for us to generate revenue on the supply chain related to coffee, not just in China, but outside of China as well. The point I'm trying to make is that all of those things required financial commitments from us, and financial commitments that we basically we couldn't comfortably make anymore given the situation with the SEC. But at the same time, in terms of when it comes to generating revenue for the company, our business in China is more about resource allocation. Okay, so we could always say, okay, you know what? We're not going to have this amount of money, but if the money comes later, then we will allocate the resource, we'll allocate the funds to something else, and then we're going to be able to come close to the revenue forecast that we had made up. So we kept monitoring the situation month after month until it got to a point where we're at the stage right now, even up until 3 weeks ago. Okay, so there was, believe it or not, there was still an opportunity for us to come close to the revenue figures, the 300 million that we had forecasted. And this is a discussion that I had with our China, the CEO of our Chinese operations, Liang Q, who is on this call right now. So we've had discussions and say, okay, you know what? Where do we allocate the funds? So do we go for the revenue and then the short-term revenue, I should say, and then basically sacrifice what we ultimately want to do, both in China and outside of China? Or do we make some tough decisions and say, okay, you know what? We're going to forego the revenue, but we're going to invest into the areas that are going to be more beneficial to the company long term. I can't get into the details of specifically what it is that we want to do, what we decided to do, but all I can say is that ultimately the business hub and the company itself, Tenet, is not about supply chain business. Okay, it is not about oil and gas or anything, or the consumer goods supply chain. Everything that we're doing right now in China, which generates revenue and profit for us, is a means to an end. I've mentioned that in the past, but I realize that shareholders are not catching on, or for some reason, everybody is still focused on what's going on with China, the supply chain, and the verticals that we're working on in China. Again, these verticals are very interesting. They're big revenue generators for us, decent profit margins. Some sectors have more interesting profit margins, but ultimately what Tenet is about is it's about analytics and artificial intelligence. Now, had we been successful in our US raise, the $30 million US that I mentioned earlier, we would be talking about, we would be having a completely different conversation today, because people would have realized that the company is not all about China and it's not all about supply chain. We would have been in a position to launch our business hub in Canada, which basically provides more visibility into the sorts of activities that we would be engaging. Now, we published an investor presentation, a Q1 2022 investor presentation, where we tried to put this forth, right? We tried to tell people, the investment community, the market, this is what the company is going to be about in the future. Not so much about China and supply chain, but more about the analytics, the data that we're accumulating throughout the business hub. And the business hub itself is not China. It's not just China. It's not just Canada. This is a global concept, right? So this is more of a social network that we're building for small and medium-sized businesses all over the world. So transactions facilitated through the hub, the data that we accumulate. We're going to be more of a market research, market intelligence company. We're going to be able to use this information to develop artificial intelligence analytical tools for stock trading, for capital markets professionals, for governments. This is where this company is headed. And had we been successful in our capital raise in the US, all of these things would have been more apparent. So we would have had revenue coming from the Canadian operations. We'd be talking more about the business hub itself, the business model outside of China, more than we would be talking about the business model in China. Unfortunately, things occurred that basically were not necessarily in our control. So we've had to deal with the situation that we have right now with the SEC. Hopefully, the situation gets resolved. But the good news is that we're taking measures. We have taken measures working with our financial advisors and some consultants to be in a position to raise capital outside of the US. Okay, so we're talking about potentially raising more capital here in Canada, which will require us to get on a senior exchange. We're taking measures to be able to do that. quick sooner rather than later. We're also looking at listing our securities on the London Stock Exchange to access the European capital markets, which should also help us raise capital in Europe, right? So we have a plan right now. We're very confident that we're going to be successful in raising the capital we need to continue to execute our business plan by raising the capital in Canada and in Europe, rather than in the US. Again, we're not throwing in the towel, by the way, with the US market. We still believe that the US, in terms of capital, by the way, okay, we are still planning on having a hub in the US after we launch the hub in Canada, but just from a capital market standpoint. So we are still planning on eventually getting on the capital markets. Again, the discussions that we've had with the SEC are still very positive. It's just the process is taking much longer than anyone expected, I think, including the SEC. So we're trying to work our way through this, but meanwhile, we are going to access the capital markets outside of the US to be able to continue with our business line. Now, specifically, what does that mean for us in terms of the revision of our guidance? So we will go this year from 340 million that we're forecasting in terms of revenue to about $210 million. Again, it's not the financial resources at our disposal had a lot to do with that, but also in China, because China right now is still generating the bulk of our revenue. So the fact that the country was essentially in lockdown for the better part of 2 months during this quarter that we're in, the second quarter that we're actually in right now, obviously will have a significant impact on our operations. So the allocation of resources, the fact that China was locked down for 2 months, basically was too much for us to overcome in terms of the revenue side that we are forecasting for this year, but also on the EBITDA side. Now, what I'm going to say about the significant drop off in EBITDA is the following. I mentioned resource allocation, and I mentioned our desire, both in China, well, particularly in China, to get into some verticals that have better profit margins for us. So getting into those verticals has been has been shifted, right, by several quarters. We're talking about insurance. We're talking about what we want to do on the clean tech space. These are business lines that have much more interesting profit margins for us. So the fact that the revenues that were supposed to come from those lines have been pushed back several quarters means that the profitability for the business has also been shifted. So that's why you see the big difference in the EBITDA. Combine that with the fact that the operations outside of China are expected to generate much better profit margins than the current operations in China. So we're talking about profit margins of between 50 to 60%. Okay, for our operations outside of China. So Canada, the US, eventually once we get to Europe and South America, the business will generate much more interesting profit margins, like I said, between 50 to 60%. So again, the fact that those revenue streams were delayed are the reasons why you see such a big drop off in terms of EBITDA and profitability, along with the reduction in our top line numbers. So essentially, in a nutshell, that's the reason for the revised forecast. Now I'm going to turn it over to Mark, who will be getting on the Q&A portion of this presentation. Mark?
Thanks, Johnson. Yeah, we got a bunch of good questions here. So I'll kick things off with following up about Heartbeat. So what sort of, you talked about how that's being pushed back, or and also how it has a better margin profile. Can you just expand on that? Like what type of time period do you see that ramping up, leading to significant revenue generation? And also, could you clarify on what about that that particular vertical is generating higher margins, and elaborate on that a little bit more?
Okay, I'll start, and then I'll pass it over to Golden. To elaborate on Heartbeat. So the good news about Heartbeat is we did have to delay the decisions, the investments that we needed to make last year to get the platform really going. The good news is that we have since made those investments, and Heartbeat actually started to generate revenue in the latter part of Q1. Jean, correct me if I'm wrong, Golden, but I think we generated about $500,000. It's not
Like I mentioned, it's $500,000.
okay, so it's not huge amounts, but it is a start, right? So Heartbeat should be kicking in to not only generate revenue but allow us to have better profit margins overall for the company. Golden, you want to elaborate a little bit on the potential behind Heartbeat going forward?
Yes. Okay. Thank you. So what's really happened is insurance is really a very important puzzle for the business hub. Okay, so business hub, I think to be like more like in a more like appropriate description is really like allow businesses doing business together. So that's why some basic fundamental elements such as payment, insurance, shipping is every business day-to-day operation needed. So so Heartbeat, we will see it's a very important not only revenue generator in the future, but also a key element for the business hub. So that's why when we actually launching the platform, is unfortunately there are some various reasons we delay for 2 quarters. Okay, but following the Q1 performance and potentially Q2, we pretty much on the schedule. So this is really what's happened. It's really the whole plan on Heartbeat was pushed back to 2 quarters. That's pretty much what happened.
Okay. Yeah, thanks for that, Golden. I'd like to get into cost of service and sort of these are more financial oriented in terms of margin, overall margin profile. So there's been a lot of question about exactly what the margin profile will look like. Last call we said it would be about 10% as a target. Prior to that, there's been talk about due to Gold River and reducing outsourcing fees that would decrease cost by up to 30%. So there's some confusion, concern about like, well, what is the margin profile and what happened to these cost savings from Gold River? Did that not pan out? So any clarification on that you can provide would be helpful.
Sure. One thing I would encourage our shareholders to do is we understand, like, I mean, there's different verticals. The business model in China is a little bit complicated. But one thing I would encourage our shareholders to do is to download the presentation, the Q1 2022 presentation that we published yesterday, where we try to give what the maximum margins are for each of the lines of businesses that we operate in, right? Okay, so answering to answer the question, okay, I'm going to give you an example, okay, of a typical transaction related to the supply chain, the consumer goods supply chain. Hopefully that will help clarify things for people. Okay, so when somebody comes in now, they come in through Gold River. Okay, Gold River is, call it the interface that allows consumer goods supply chain clients to place orders on the business hub, right? So they want to purchase a product from an authorized supplier on the business hub. So let's say the order is for $100. We're going to use simple numbers here. So the order is for $100, and they're going to need, we offer them financing for that purchase order. We offer them to ship the product to a location of their choice. And if they want inventory, to be able to track the inventory, if they want warehousing, they can do that through Gold River. And we will charge them for those services. We will charge them, let's say, 2% of the value of the order. Okay. So that 2%, let's call it $2. Okay, so it's $100. It's $100 for the order. We charge them 2%, and that, excuse me, $2. That $2. So we have our fees for financing. We have our fees for shipping and for the use of the Gold River platform. Okay, so that's our revenue. That's what we recognize in our books as revenue. Okay, before in that 2%. Okay, when we were outsourcing, what Gold River is serving as right now, okay, so in that $2, our margin would be, call it like 2%. Okay, from that 2%, we would get 2% margin. So we would make initially, right? We would make, call it, what's 2% of $2? So
Four cents. 4 cents.
40,
4 cents.
4 cents.
Yeah.
Okay. All right. So 4 cents, right? So it was completely negligible when we started out because we're outsourcing everything. Okay. Now what we're doing with Gold River, okay, is that instead of outsourcing the use of the application for logistics and for shipping, we're taking that over. So we are keeping much more of what we're spending over to Rong Yutong. So instead of having 2% margin, we're now increasing that to about 10% that we're making. Okay, 10%. So from 2% we go to 10%, and that's the increase that's the benefit that Gold River is providing. But right now, okay, so the logistics, the warehousing and shipping, we're still outsourcing that right now. So what we're doing also, when I talked earlier about rounding off the offering for the business hub, the shipping itself now that we're outsourcing to a third party through the Unfleet platform, we're keeping that. So eventually, as Unfleet comes in, also we're going to be able to keep greater margins, okay, a greater portion of the revenue that we're generated on each transaction. So instead of going from 2% to 10%, which is what we're making right now, we're going to be able to increase that to 15% or 20%. Okay. Now there are certain transactions, if they don't require warehousing or shipping, whatever, we have reduced bundle services where we make more interesting margins. So in the presentation that we published yesterday, you're going to be able to see that we can go up to, I think on the supply chain, consumer goods financing, we can go up to 30% margin. And again, the margin is not on the total value of the order. It is really on our portion that we charge for the service that we provide through Business Hub.
Okay, great. That's super helpful. Sort of along similar lines in terms of some of the supply chain transactions. On the statement of cash flows, there's a couple line items: deposits made to third parties and prepayments to third parties, which are fairly significant amounts. Can you just clarify what are those for? What are some of the terms on that? Like how much do they support revenue? And just kind of go over those two lines. I don't know if that's for John or Golden or you, Johnson.
Okay, again, I'll get started on the explanation. The business, our business in China, we do business with several different financial institutions, okay, banks or finance companies. Now, Business Hub is still fairly new to these financial institutions, right? So they depend on our analytics in order to determine whether or not they should lend to our clients, right? These Business Hub clients. Now, for certain orders, these financial institutions are asking us basically to put a 5% guarantee, so to speak, 5 to 10% guarantee on the total amount that they're financing, that they're lending throughout the platform. And basically, we put that as a guarantee. But what we do is we also secure our guarantee that we provide with the products that are being ordered throughout the platform. Okay, so our capital is never really at risk. So we use this amount basically to provide additional comfort, so to speak, to the financial institutions that are making loans on our platform. This amount is not an expense for us. There are no terms, essentially. There's no interest being charged one way or another. So it's kind of like a revolving line of credit that we use in order to help facilitate transactions throughout the platform. So this is our money, and it's not really at risk, if I can put it that way. Golden, Jean, feel free to add anything if you want to add to what I just said.
No, I think it's a good summary, and an important point is I know that the amount is significant, but the amount of transaction is also significant that is supporting. And the good part of it is that the management team in China make sure that all these money is secure. So by the customer, by the bank, or somebody, a third party will guarantee these amounts. So we're not at risk to lose that money, and we never, since we begin this process, lose any money on that. So no, we don't have any bad debt with these money. So I think it's important that it's secure, right? It's like a revolving line of credit that we're not charging interest, but it's bringing profitable transaction on the platform, and it's secure.
Yeah.
Okay.
One little point. Sorry, Mark. Is that
That's okay.
During the operation, we also decrease the percentage that we have to put up in the what we so-called security deposit. And because more and more financial institutions and clients trust us, so we see that this number is actually decreasing. So in terms of percentage, okay, before we start with some supply chain, we start with 15%. And during some time, it reduced to 10%. And after some time, it reduced to 5%. So with the same amount of money, we can leverage more trust from the financial institutions and from big clients. So this is pretty much what happened.
Okay.
Okay.
Awesome. Yeah, Golden, while we have you here, could you talk a little bit about BDC, Link Steel, Unifleet, and just kind of maybe even the China Industrial Bank accounts, and just what you see, how you see that ramping up over time, in China?
Okay. So what really happened? Okay, I saw some questions regarding people concerned BDC and also CIB and also Unifleet. Okay, so first of all, I wanna give everybody a kind of like 101 on the supply chain. Okay, so what's really happened is the in the supply chain there are three major like basic components. Basically, without these three components, you can't do supply chain. Okay, so talking about people buy and sell at daily basis. Okay, payment is a key. Okay, so without payment, we can see Business Hub is a hub for people know each other, but no concrete transaction is happening because there's no payment. You don't control payment. People know each other on your platform. They make deal offline. Okay, so payment is the key to put people doing business online. So CIB, Union Pay, and you will see in the future other payment institutions gonna join the platform. It's all about this. Okay, and so this is the main reason we are very excited about Union Pay CIB partnership, because essentially those are bank account. Okay, people open our platform. Those are legitimate bank account, very, very serious. Like you open bank account in RBC, in TD Bank, okay? And basically TD Bank tell the client, okay, on this bank account, if you want to transfer any dollar in and out, you have to get a permission from the platform, Gold River platform. This is a huge control handle for us. So that's why we're very excited about press release, those exciting news. And to do that, we have to get 100% trust from the financial institutions and also clients. So that's how about payment side. So Union Pay, CIB, it's all about this. Okay. And Unifleet is on the other side is the shipping platform. So once the client did the payment and everything, okay, we also want to track what's going on with the logistic. Where is the product? Okay, it's just like you not only control the money, you also control the goods. So this adding another extra layer to the supply chain. So make sure the fund, the financing, everything is safe. Okay, and the third layer is we need to be influential on the market and in the industry. Okay, so if we are a platform that we do any transaction, okay, but we're small in each verticals, then we're not important. We only make money on shipping, on loans, whatever. But there's a cap on that. Okay, when I see we're influential in the verticals, means I want to be something. Gold River. Okay, if you want to do this business, you have to do with Gold River. Okay, it's just like in China before. If you want to sell online, you have to go with Alibaba. Okay, so this when we actually involving into an influential party in some vertical partner in some vertical like industries, then our margin will increase dramatically because people use you not only for financing, shipping, whatever. Okay, but they use you to do business to enable their business. So this will dramatically increase our visibility and profitability in any like business transactions. So that's why, okay, Johnson talked about, we have verticals, we have different side of business that we try to struggling on how which resource goes where. Okay, so this is also explain the whole situation about the Good River situation, and also on the other side the insurance. Okay, adding another layer that on top of this whatever I just said. Okay, insurance is also a basic element for all the supply chain. Okay, including shipping, the quality of the product, the financing or guarantee insurance, and there's a lot of liability. There's a lot of like risk control related insurance policies that can be associated with Good River. Okay, so these are all really all the synergies happen on Good River. That's why this company called Asia Synergy. Okay, so so what's really happened on top of that is BDC and other like BDC, by the way, just a client of of Good River. Okay, so we have many clients like BDC, like like coffee, like many of these clients and partners. So this is pretty much I want to give but everybody what's going on top of what Johnson and John already explained to the market.
Awesome, thanks for that, Golden.
Yeah.
Couple follow-ups on the finance side. So Johnson, could you go over cash burn rate or expectations for, I guess, the year or what you see? And then also, since we're talking about raising capital a lot, I think there's obviously concerns about where the stock's at and potential dilution. So how will the company go about thinking about that if as you're looking to raise money in terms of the type of financing and just your general strategy on that?
Yeah, sure. Yeah, so obviously we realize that we know that capital we need capital to progress, right? So we're very conscious of the fact that the markets have taken a downward turn. So we're not looking to raise like hundreds of millions of dollars at whatever. I don't know what the stock is trading at right now, at like $2-3 or whatever it is, whatever it is. So we're very conscious of that. So any raise that we would be doing right now would be limited to the amounts that we need in order to continue to go forward, right? So our plan is to do raises and tranches. So we're looking to do a first tranche, obviously, as quickly as possible. And the instrument for that has not yet been determined. So it's not necessarily going to be equity. We're looking at potentially doing, having a convertible debenture or doing a straight debt instrument. We haven't determined that yet. We're still in discussions with our financial partners. And once we make that determination, obviously we will let it be known to our shareholders and to the market. But the point is well taken. We realize that, okay, you know what, the stock is not at $12 to $14 or whatever it was when we're first contemplating doing the U.S. raise. So we have to take that into consideration, and we'll take that into consideration. As far as like what our burn rate is, listen, we're not going to run out of money. Like we're not going to run out of capital. We have a plan. Like I said, as soon as we get through this call here, this filing, this Q1 filing, we're going to put our plan into motion. So announcements related to what we're planning on doing with the financing, whether it's the filing of a prospectus, that should come fairly quickly. And all indications are that the capital is there for us. Again, we've been talking to our financial partners to gauge the level of potential interest for a raise. There's still quite a bit of interest, obviously, for the company, for what we're looking to build. So the capital is there. It's just a matter of, okay, what instrument do we use to get that capital? Okay. So in any event, like, I mean, before we run out of money, if we find ourselves in danger of running out of money, what we're going to do is we're going to cut Jean's salary, and then we're going to save a lot of money. So we'll be fine.
Okay. All righty. I got one more question here for you guys, and that's Johnson, just pivoting towards the cubular in Canada and North American expansion. And could you just talk about that? Obviously, we've done a lot of hiring, started to attend some trade shows. How's the messaging there and like the reception? And could you just talk about, how you see that ramping up over the next couple quarters to get us going?
Sure. Listen, the launch of our hub in Canada is so important for us for so many reasons. I think without that hub being launched, it's difficult for people to see what it is that we're trying to build in terms of this global network, right? Because unfortunately, China being what it is, you can't really give too much visibility into what's going on in China. Whereas in Canada and in the rest of the world, people would see that, okay, you know what, this is more of a social media platform where you have a dashboard, you can post messages, you can network, you see advertisement, like, it'll bring it home to our shareholders, I believe, once we launch. So that's why, to me, I was very disappointed that we weren't able to, that we still haven't launched the platform yet, and I can't wait for us to launch it. Now, to your question about the reception that we've had at these events, think about the offering for a minute, right? So if you are a small business, and like just the example of Restaurant Canada, right? Like Restaurants Canada was one of the events that we attended earlier this month. So if you are a restaurant owner, you just went through 2.5 years. I can't remember how long this pandemic has lasted now, but you've gone through at least 2 years of very, very difficult times, right? So if you are a restaurant, you know that restaurants typically are one of the businesses that have the most difficulty getting loans, okay, from banks. Think about what we're offering here. What we're offering here is an opportunity for these small businesses to have much easier access to credit, to be able to manage their cash flows more efficiently. That's one thing. Okay. If that was the only offering if that was the only thing that we're offering to these small businesses, it would be interesting enough for them to join our ecosystem, to join our business hub. But in addition to that, we're also offering them the ability to the possibility to advertise their products and services for free. We're giving them the opportunity to network amongst each other. We're giving them market research information, okay, potentially, okay, who's hiring, who's not hiring, how the industry is doing. There's a lot of insight that we're going to be providing to these businesses that are going to be extremely helpful to their operations, right? And so when you look at the total offering, we're offering to the businesses, and once our representatives at those events had an opportunity to really exchange with these small business owners, these restaurant owners, the reception was very positive. Okay, so people are excited about the eventual launch of our business hub. We're going to ramp up our pre-registration campaign, and hopefully we're going to be able to communicate some information to the market in terms of how well the pre-registration campaign is going. Now, that's on the small business side. On the financial institution side, the credit union side, again, the event was very successful for us. The feedback that I got was, why not? If you are a financial institution, this is a way for you to acquire new clients and to get more opportunities to expand your loan book. So we are bringing you perfectly matched businesses, okay, businesses that are perfectly aligned with your lending and credit criteria. So it's a win-win for everybody involved. So the reception has been very good. To answer the question, Mark, the reception has been very good, and we look forward to ramping up such activities and get more small businesses pre-registered, more financial institutions pre-registered on the platform before we eventually launch it.
Awesome. Yeah, can't wait. That's pretty good coverage of the questions we've got. So, Johnson, I will turn it back to you for some closing remarks.
Okay, thank you, Mark, and thank you everyone for attending the call this morning. I know it was early; it's not what we typically do, so we appreciate your presence here. It's been difficult, yes. The last few months for the company personally, for the markets in general, we were affected, unfortunately, negatively by what took place on the U.S. Capital markets. But we do believe that we have a plan that will allow us to rebound from there. So we've updated our forecast, and we're very, very confident now with the numbers that we've put forth. I know for some of you, for most of you, the numbers are probably disappointing shorter term, but we believe that we're going to benefit down the line from the revisions that we've done and from the decisions that we've made, because ultimately the company is going to be more profitable. And we also looking very much forward to having the Canadian hub launch so that you have more visibility into this concept that we're putting together. This global concept about linking small businesses around the world, getting financial institutions involved, and really changing the way SMEs do business around the world, and using analytics and artificial intelligence to do that, and then developing all these revenue streams for the company. So I really encourage you to take a look at the presentation. Oh, and by the way, if it's not already done, the Tenet website is also being revamped. I think before the end of today, we will have a new website basically that puts forth what we're trying to do on the analytics and artificial intelligence front, as opposed to just the focus on supply chain in China. So once again, thank you very much for your time. We have a plan basically that we believe you will be happy with. So just hang in there with us for a little while longer. You won't be disappointed. Thank you.